Welcome everyone to this week's weekly news with the Artless Dialogue, and it's me as always, Ash Mohammed, and joined with Saud. Hi Saud, how's it going?
Hi Ash, I'm doing good. How are you?
Not too bad, thanks. Not too bad. It's been an eventful week with the weather, because being in the UK, we love talking about the weather, and it's been snowing, which
Yeah,
is
no,
which
it
is
has.
random.
Yeah.
Yeah,
And then the past
we're
few days
definitely.
were quite sunny as well. So,
Yeah, we'll have to do an episode on kind of the effect on climate change and ESG on the world and finance and business, because we're certainly seeing extremes in temperatures,
that's true.
which is kind of causing all sorts of issues. But anyway, this week's topic, I'm guessing we probably looked at the same topic at least, and then considered it or not. So why don't you tell us what you looked at?
Okay. So, so I looked at what everyone else was looking at in the world as well. The
It was hard
silicon,
to miss it.
hard to miss it. Yeah. And I said, let's go for the obvious choice, the one everyone's talking
Yeah,
about. Maybe we can add something new to the barrage of news. Uh, so Silicon Valley Bank collapsed. I think it was Friday, a couple of days ago.
yep,
And I
yep,
thought it'd be interesting to talk about that. So I'll
yep,
get into it and I'll talk you through the timeline and the story about what happened.
yep,
And then, okay, so first thing, uh,
yep,
inflation all over the world in the UK, in the US, Europe, Asia, everywhere. And
yep,
what do central banks sometimes do in case terms of inflation? They raise interest rates. And
yep.
what happens when you raise interest rates? What's the plan behind doing that? So what they plan is that cost of borrowing increases, so people won't take
Yep.
out loans to spend money; they'll save their
Yep.
money. And according to demand and supply, as people don't have money, demand they
Yep.
spend less money, demand decreases, and so does
Yep.
price decrease. And
Yep.
that's the opposite of inflation. So banks wanted to raise interest rates to sorry, the Fed wanted to raise interest rates to decrease inflation, and that's what they did. But what happened was that because of this, the cost of borrowing increasing, investors became more risk averse. They didn't want to invest in risky startups, risky tech, and so forth. So now comes in the Silicon Valley Bank. The Silicon Valley Bank's main customers, primary customers, are tech companies and tech startups. And as we all know, startups need funds and money and investment to grow, develop, expand, and so forth. And when people didn't want to invest in risky things like startups, these tech startups didn't have money for their purposes. And so they started withdrawing funds from the Silicon Valley Bank to meet their running expenses, their payroll costs, research and development. When so many startups started withdrawing funds from SVB, SVB needed money to pay them back and to maintain their capital requirements. So what they did was they sold about $1.21 billion worth of US Treasury bonds at a 1.8 billion loss, and they had to make up for that loss. So they decided to sell stock and raise capital that way. They announced that they'd be selling $2.2 billion dollars worth of stock. And by the end of that trading day, the stock price had actually fallen 60% because some people knew what was actually going on with the interest rates and startups taking out money and SVB not having enough capital. Their stock price fell. When their stock price fell, they lost investors. They couldn't raise money. They couldn't pay money to startups withdrawing money, and hence they collapsed. So that's the story of what happened. Ash, you've probably
Yeah.
heard about this. Anything to add?
I mean, it perfectly well positioned in the story, Sal. Then for
Yes, you
those who've kind of for those who've probably seen the 2007 2008 credit crunch, and you've probably heard of Lehman Brothers and the run on banks. I mean, this was kind of exactly that. It was classic. Here's all the indicators, as you said: interest rates going up, inflation going up, cost of borrowing going up. Not particularly capitalized bank,
were.
not particularly kind of liquid bank, and all of the kind of the things and the warnings of 2007, 2008 were kind of, ignored. And then, as you said, all of those steps happened,
Hmm.
and you could see the dominoes falling, and you could see that once that momentum builds, and you hear the phrase "I run on the bank,"
Yeah.
that was perfect. Run on the bank, because then it's like a perfect storm. because you start, your access to funding disappears because nobody's willing to lend to you.
Yeah.
Your existing customers pull the funding out. So because they know something bad's happened. So even your good investors are now going, I want to go and put my money in a safe bank because I'm not sure what's happening to this bank. So that has a cumulative effect. And then, it all starts circulating. And before you know it, the bank's gone under, and has an impact. So yeah, no. Interesting duplicate of 2007, 2008.
Yeah, and just like back then, each banks are such intervened with the community and the businesses around them that it has a ripple effect. And the ripple effect hits tech companies and it can hit globally as well. It's hit the UK, and we can get into that in a second as well. But the two main things that I thought of, a couple of main things I thought of regarding this SVB like falling and not being able to pay tech firms, is the impact it'll have on the tech industry. One of our last episodes, we talked about hundreds and thousands of layoffs. I think this is going to increase layoffs. These startups are going to start laying off people because they have money. Paychecks are going to be delayed or reduced or something, and they won't have money for research and development. It's going to harm the employees, the staff working at those firms, and it's going to harm the progression of tech as a whole until those startups get back on their feet or new ones replace them. And
especially especially when you think of most of these tech startups, it's kind of venture capitalist type funding. So their funding round is kind of quarter by quarter by quarter, and they need to hit that target, but they also need the funding. And most of these, wouldn't consider Revolut or Monzo to be fintechs anymore because they've been around for so long. But even now, 5-6 years after, of multiple hundreds of millions, if not billions, invested in the likes of Revolut, they are only just starting to turn a profit. So there's a very long-term investment in these kind of industries and a much greater risk. The reward in theory is higher because it could be the next the next Skyscanner or the next whatever it is, where you go, it becomes a unicorn and it becomes a 1 billion valued business.
Yes,
but the risk is high. And what was interesting was Silicon Valley Bank. It was the lack of diversity in its portfolio.
I was just about to say that. You stole my point, Ash. Go on.
Talk to me about the lack of diversity, Sal.
No, I'm sure you can talk better about that. So why don't you go on?
No. I mean, I think that's really it. There was a lack of diversity. I mean, it was kind of, again, it's just interesting now when you step back, and obviously there'll be lots of papers on this and lots of postmortems on this, and everybody will go, how did we miss this? And how did the board miss this? And how did the investors miss this? But really kind of obvious things going on. Investing in one area, really high risk, high reward. A lack of capital holdings, and therefore your risk is that much greater.
Yes.
And if you look at UK banks, UK banks have to hold X number of tier one capital ratio, capital tier one ratio capital. So therefore you go, it just had all the indicators of something that was about to go, but not particularly diverse.
Yeah, no, and that's like one of the basic rules of investing or revenue streams, or even if you look at personal finance, have a number of different revenue streams, have different diversify your investments. That's like making money 101 if there was a class. But I think that's interesting as well. So it's funny how even the most largest institutions can miss some things like this. But I guess.
Go on, sorry.
Yeah, I guess that's the thing about this world. It's complex and everything, and with so much uncertainty regarding like inflation and the recession coming or is here, and I guess it's hard for companies to react appropriately at all times as well.
And it's that classic kind of like that kind of corporate memory, isn't it? Because it's almost like we've passed a generation now who've kind of forgotten 2007, 2008, and how close the whole thing came to collapsing. when we had, Barings Bank, Lehman Brothers, and UK banks, and it was such a systemic failure across the whole industry. And only a few regions, kind of avoided it, in the Far East, Australia, etc. But pretty much most of the rest of the world was on its knees for a good period of time.
Yeah.
And then here we are, 12, 13, 14 years later, and we had a bank set up with its only goal, which was to invest in startups.
Yeah.
As you said, not diverse. All of the trigger points, which, and even I read that they didn't have a CRO in place, Chief Risk Officer, since April 2022.
That must bug you, especially
But
being very in risk.
yeah, exactly. But it's interesting how, that's allowed to happen. So clearly there's a kind of, you kind of go culturally in the organization. If you're sat around the leadership, the exco, the bank, here's the board, etc., you don't have a CRO in place. I mean, that's another kind of warning signal right there, isn't it? Because, it's been a year and you don't have a chief risk officer. It's interesting how those questions weren't asked. And I'll be kind of watching with interest when they do the post-mortem to say, why weren't those questions asked, and where was the regulator in this? Because if you think the regulator is usually quite on this, and,
yes,
and you go, this is a bank operating in the UK, and yet these indicators would suggest it wasn't kind of meeting the criteria, but regulation didn't seem to kick in. So that'll be another one where the regulators will now need to kind of go back and look and go, right, how did this one get through the net?
Yeah. And it's not like it was a small bank. It had almost $200 billion worth of like assets in it. I really liked one point you said. I think you said we have short-term memories when it comes to financial crises because we keep making the same mistakes. That reminded me of a book I read. Haven't been through it all, but I've read some of it. Out of Pocket. Have you read that book? Heard of it?
I think I've read bits of it. Yeah.
It's quite. I think it's quite popular among the finance world. It's about how all of the financial crises, recessions, frauds, or whatever, they happen because of the same few reasons. Repeat. So I think if any of our viewers are into learning more about financial crises, why they happen, how you can avoid them, Out of Pocket is a good book to read. So I guess this is an interesting topic, Ash.
Definitely.
What was on your list for this week? Yeah.
Well, just before we start the list, but another recommendation is watching a film called The Big Short with Christian Bale.
Oh yes.
Brilliant film, right? If you kind of if you want someone to explain to you like why the credit crunch happened, it's done in such a clever way. But it'll be interesting when the way they show all the different things as to why it happened. It's pretty much repeated in the Silicon Valley Bank. They've kind of repeated the mistakes. They should have watched that film and maybe would have avoided it. Maybe that's the answer. So my kind of topic, because obviously I read lots about Silicon Valley Bank, but the other thing that kind of caught my eye was around payments and embedded finance and embedded payments.
Okay.
Again, we've talked about this in our podcast a while. And when we talk about embedded payments, embedded finance, it's where companies put in finance in the journey. So rather than you kind of go in and always using your bank debit card, etc., then the company, and it could be anyone, it could be John Lewis, Marks and Spencers, it could be a car company. They are doing the transaction, and the reason they're doing that is they want the income to do with the payments. And what I was looking at is Mercedes. And so Mercedes in Germany in the past have already kind of introduced a localized sort of payment, sort of clever payment in their cars.
Okay.
So what they do is they build the car with all of the hardware. So like, when you get a new car and you go, I want this, this, and this, all the cool gadgets. And then you realize the car now costs twice as much as what you thought it was going to be. Well, what they do is they build every single car with all the gadgets already in.
Yeah.
But they're disabled. And so they have a two-factor authentication. So you have to register your debit card or credit card or whatever, but they also have a fingerprint ID in the car. And so you can say, right, I fancy my, my surround sound or my reverse cameras to be on, or I want my automatic parking to be on, but I only want to pay for it for 3 months or 6 months. And so you can now pay for it in your car, and it's activated for a period of time. So you kind of get subscriptions. And so it's quite clever for that, because you can then go, I want my sat nav to be for Europe because I'm going for a drive in Europe next year or next month. So it's really clever because it now makes the payment really effortless. You don't need to go to the car manufacturer. You don't have to make the decision at the point of purchase, because everyone's been there where you sit in the car dealership and they're pestering you, and you've got this massive long list of things to choose from, and you're like, oh, do I go for a sunroof? Do I not go for a sunroof? Or do I go for a convertible? Oh no, I'm in Scotland, so I'm never going to need a convertible. All this stuff, you have to make that a point of purchase. Now you don't. Now you can just buy it anytime you want. And the other thing they've started doing, which they're just trialing now, is the ability to pay for fuel in your car.
Okay.
And so again, you go to a fuel stop, it scans your reg plate, you put the fuel in, whether it's electric, diesel, or whatever, and then you just pay for it by thumbprinting your car. And the clever thing with this is the usual is all of the things it allows you to do in the future. Yeah. Which is in the future, and we talked about this a while ago in our podcast, we kind of like, we read the future side. We're like, we should come up with a kind of a crystal ball, is, people not owning cars anymore.
Yeah.
And so the future is you go to a car, you kind of go on the app, the door unlocks for you, you go in and you thumbprint and you go, right, I'm going to pay for this car for this length of time. Now, you might only pay for it for the commute to the office. Yeah. And so you paid for an hour's worth of that car. And all of the stuff like the insurance is all built into the price. So you're insured, you've got everything built in, and you go, right, that's going to cost me, 20 quid an hour or whatever it costs me. And then suddenly you've got, fewer cars on the road. You've got, car manufacturers going, right, it's all about positioning the vehicles. It changes the whole kind of market when it comes to cars and owning cars, because the ability to pay in your car suddenly gets switched on.
That's quite interesting, like micro rentals, and because you've got the mobile application on your phone already, you don't have to fill out that lengthy application form and give your documents, because they're already in the app. You just go tap like you do. Yeah. There's this thing called I think those bicycles in Glasgow.
Yeah, and bicycles.
You go and scan your app, and So I think that's quite interesting. And that can change the model, but more so the subscription model. I actually was talking about it with a colleague recently. The subscription models, and that is it's quite interesting, because instead of paying £30,000 more for heated seats and luxury and like that kind of stuff and those facilities, you don't have to pay the amount. You can just pay it when you need it.
Exactly.
Like for a day or for a couple of months, or in the winter you can pay for heated seats, and in the summer you can stop paying for it. I think that's good. But it is innovative ways of making money and improving cash flow for these companies. But what I was thinking was from an accounting perspective, or from an insurance perspective. So first, from an insurance perspective, if there's an unfortunate incident, if there's a car crash, the person didn't pay for the added expenditure of those electric seats or for those extra facilities. I can't imagine what they would be. But so how much does that person have to pay for then? Because his insurance would be aligned with what the value of the car is, and the value would include those facilities that he's not taking benefit of. I don't know. Do you have a thought on that?
Yeah. No, but it's a really good point, actually, because the same would apply to kind of tax and benefit in kind. So if you've got a kind of company car, they base it on the value. So do they base it on the value you purchase at point of purchase, or the total actual value of the vehicle, even though you've got those devices disabled?
Yeah, because they'd have to fix those devices as well.
Yeah, that's an interesting point. Because one of the things, one of Mercedes' kind of logic is that it doesn't really cost them that much extra to fit all the cars equally.
Okay.
Generally speaking, there's a few extras, like when you get to alloys and stuff, fair enough. But for just the software and some of the hardware in the car that you don't see, it's actually just as costly for them. So it's a huge profit margin. Therefore, if you're then tempted to go, I'll just go to subscribe for all the cameras and stuff. But no, that's a really good point about insurance, because that means that the value of the car you put on an insurance claim is different to the value of the car. So I don't know whether the car company then takes the hit and absorbs that, because they go, right, that's because otherwise, then yeah, people are just going to go for the cheapest model all the time and get a lower insurance value and then just subscribe for the extra stuff. I don't know. It's probably something they'll need to think about if this is ruled out.
Yeah.
And
I was thinking of another thing as well, like those, for example, those facilities, those extra equipment in the car that the driver is not using because he paid less for the car.
Yeah.
Are those things in ownership of the owner of the car or in ownership of the organization? Because that will depend how the organization will account for that equipment. Is it their asset, but or not? Because so it can get quite technical, I think, from an accounting perspective.
I think so. If Mercedes are listening, give us the answer. Tell us if you figured that out, and if you have, let us know. And if not, if you're figuring out, we've got lots of good questions to consider. So
or hire us, helpful. And we can help you solve that problem.
Exactly. And talking of subscriptions, good segue now as we end this episode. Obviously, subscribe and like, and we'll talk to you soon. So take care for now.
Perfect. Thank you. Bye, everyone. If you like this video, please like, subscribe, and share with your friends. And if you want similar content, check out our other videos.